Hello, good evening, and welcome today in the next session of our six digits tax series. Today, we will be continuing the tax computations topic with a new trainer. Ali Hamza will be joining us from EY for the same purpose as Farhan and Mr. Awais joined. So, I'll welcome Ali Hamza to formally introduce himself and tell us about himself.
Thank you, Feroz, for the introduction and welcome all the attendees. It's Ali Hamza, working as a senior manager, international tax and business tax advisory in EY Pakistan since 2015, and very excited to deliver such this initiative and training to you guys. So, without wasting any time, we should start with our session. So I take this opportunity to give you a brief recap of the tax computation part 1 previously given by the another trainer, Mohammad Farhan. And obviously this session would also include the detailed overview of how to compute business income under the Pakistani local tax laws and other income from other sources, and how to treat the tax losses while computing the taxable incomes and tax liability thereon. So as part of the quick recap, the previous trainer Farhan has given you the overview of the salary, income from property, capital gain, and this session would be comprises of detailed discussion on the income from business and income from other sources. So mainly the salary was any amount received from the employer in the nature of revenue or capital, which obviously varies from different allowances and perquisites, and with some exceptions, all considered to be as a salary income of the employees and taxable under the head salary. And obviously the computation of the salary income was on the basis of receipt basis, and it wasn't computed on the accrual basis. And the other main concept was the tax treatment of main perquisites and allowances given by the employer to the employees. For example, employee maintained car, accommodations, loan given at the reduced rate or free of interest. And obviously there was a main topic about the employers giving employee share scheme to their employees and the taxation thereon, and including other retirement benefits forwarded by the employers to its employees. Farhan had also covered the property income, rental income giving rise from the rent of immovable properties, including both constructed buildings and open lands, open plots. And I'm sure he has explained the meaning of rent and admissible deductions and treatment of non-adjustable amounts thereon, for example, pagdi and advances. Another topic previously discussed was capital gains, the gain arising on disposal of capital assets, for example, immovable properties, shares, any asset which is not in the nature of stocks and depreciable assets may give rise to the capital gains on disposal of such assets. And the tax computation and impact of holding period to the tax computation and tax liability thereon. So if any one of the attendee have question of the previous part 1 of our tax computation, can text question or raise a question when the turn question answer session comes out, so that I can also give you the intro or detail of any part if someone is interested to know more about tax computation part 1, mainly entitling of income from property, capital gain, and salary. So we can now jump onto main topic of today's session, that is income from business, which is obviously a detailed topic, mainly related to the business entities, companies, and other individuals and AOPs who are conducting and using business as their main source of income. So this capital head, or this head, is to be construed as main main head of the taxable incomes. So if someone wants to understand the tax system of Pakistan, it's very important that the nitty-gritties and details of income from business should be considered while computing overall tax computation or filing the tax returns of a taxpayer. So before getting into the details of income from business, uh, we should know what actual business is. So the business is not any specifically or any specially defined in the tax law. That is what generally connotates or generally presumed as a business in normal course of our understanding. Though our local tax law has provided a specific definition of the business, however, in generally it is considered as the general meaning of the business to be a business income taxable under the tax law. But for the sake of completeness, we have produced a definition of business income here, which includes any trade, commerce, and manufacturing profession, and it varies obviously from manufacturing to service sector to trading to the commercial import and selling the goods. So every kind of uh, uh, trade or every kind of adventure which is in the nature of normal course of business would be construed as a business under the local tax law. And obviously, the nature of economic activity would be dictating whether the underlying income would be giving rise to the business income or not. For example, I have produced an example here that if a person is regularly selling immovable properties, is engaged in the business of regular purchase and sale of immovable property, then the underlying income should be considered as income from business rather than capital gains. And accordingly, there's another example. For example, profit on debts of banking companies should be considered as business income of the banks, not as income from other sources or any other income chargeable to tax under heads other than income from business. So the principle is that the business, the normal activities, the normal course of activities would dictate whether the underlying activities is giving rise to the business income or not. And there's another example given under the law that if a scheduled bank is regularly engaged in leasing the assets and rent leasing the assets, and the income arising thereof would be considered as a business income of such lessor oblique scheduled banks, and it should not be considered as any rental income or any other class of income. After discussing the major, or you can say the primary concept which giving rise to the business incomes, we should be very vigilant to know that the tax laws allow specific deductions to come at the net taxable income which would be subject to tax. For example, in case of corporate taxpayers, the net taxable income or net business income or profits of the business would be taxed at the rate of 29%. And obviously, as also in other jurisdictions, that we have to come taxable profits after making certain adjustments in accounting profit to come at the taxable profits, which will in turn be subject to the tax rates as applicable under the local tax law. In Pakistan, the general accounting framework is IFRS, and normally the corporate entities prepare their accounts by following the international financial reporting standards. And and obviously the tax law would is providing certain adjustments which would be made in accounting profit before tax as shown in the financial statements to come at the figure of taxable profits, which in turn will be subject to the taxation in Pakistan. So the law provides a general principle for allowable deductions is that any expense which is incurred wholly and exclusively to earn the business income will be allowed as a tax expense. I can give you an example here that if an asset is used partially, for example, an individual is doing a business and an asset has been employed for such individual's business, but part of such asset is also used for personal usage, then obviously the partial depreciation of such assets would be allowed as business expense, allowable expense to come at the net business income, and the personal part would not be allowed as a business expense to come at the net business income. So this is the general blanket principle has been told by the tax law that expense to become allowable should wholly and exclusively should be incurred for the purpose of the business. And obviously there are two types of expenses. One is capital expenses, and second are revenue nature of expenses. And revenue nature of expenses would be available as a period cost even to come at the taxable profits, and the capital expenditures to be allowed in a shape of either depreciation or amortization of pre-commencement expenditure, which will be discussed in detail in ensuing slides. So here are the major important tax adjustments, important examples of tax adjustments that a preparer of the tax computation should keep in mind while coming to the taxable profits. Uh, Although some of the expenses would be allowed as an expense while preparing the financial statements of a company, however, the tax authorities and the tax law would not allow such expenses while computing the taxable profits to be taxable under the business income. And the important examples are any tax or any cess or any levy paid in the nature of tax, if it is computed or computable on the basis of any profits, would not be allowed as a allowable expense under the law. For example, if someone's pay profit-based agricultural income tax, then it would not be allowed as a tax expense under the tax law. There is an exception to this rule. There are certain labor-related levies which, although computed on the basis of profits, namely the worker welfare funds and all that, but that is allowed as a tax expense as a deductible allowances. But other than this exception, any cess or levy which is to be computed on the profits would not be allowed as a tax expense while computing the net business income. And there is I'm coming to the example B. There is another detailed obligation prescribed by the tax law for on the withholding agents. So withholding agents, while making payment of any expense, is required to withhold certain taxes depending upon the nature of the expense and depending upon the payment mechanism and all that. If such withholding agent fail to withhold tax while making payment of expenses, then such expense would not be allowed as a tax expense under the tax law. Although it would be allowed as expense while computing the while preparing the financial statements. However, under the tax accounts, it would not be allowed because there is a specific limitation prescribed by the legislature that if withholding obligation has not been met while making payment of the expenses, then such expense should not be allowed. The pertinent example under this category can be, for example, salaries. If a company, being an employer, is required to withhold tax while making payments of salaries, and if the company failed to do so, then the underlying salary expense would not be allowed as a tax expense as well. Coming to the another important example, which is C. The prescribed entertainment expenses, only prescribed entertainment expenses would be allowed as a tax expense while computing the business income. And general nature of entertainment expense would not be allowed. And the rules provided by the legislature has prescribed certain conditions and certain situations where entertainment expenses can be allowed as tax expense, which has been listed here, which includes obviously the meetings, entertainment expenses incurred at the meetings of shareholders, agents, directors, customers, and employees, and opening of new tranches or businesses or branches of business. Any entertainment expenses incurred on such incidents would be allowed as a tax expense. And other than that, the general nature of entertainment expense would not be allowed. So under in Pakistan, coming to the example D, under Pakistan, as per local labor laws, every employer has to give at least one of the retirement benefit, for example, provident fund or gratuity. So normally business and entities running the business have employees and obviously have to provide us retirement benefit, at least one retirement benefit to its employees. And the law prescribes that if such retirement benefit is not approved by the relevant authority, which obviously include certain societies and also tax authorities, if the contribution is made to unapproved provident funds or pension funds, then such contribution cannot be allowed as a tax expense while computing the business income. But this is a general principle. The exception to this general principle is that if such provident fund is unrecognized, then the company is have to make sure that while when this retirement funds would make payment to the employees, then the employer have to deduct relevant withholding. If such withholding has been made, then such expense would be allowed even the funds were unrecognized. So this mainly the D. This example mainly covers D and E of this slide. Last important example of this slide is fine and penalties payable under violation of any law, rules, or regulation. This generally creates a permanent difference because while computing the profit before tax as per financial statements, while preparing the financial statements, there may not be any such restriction not to allow any fine or penalty as an expense. However, in the tax law, such fine or penalties would not be allowed as a tax expense. That may give rise to the permanent differences while computing. If someone interested in knowing that what is deferred tax and deferred differences, then fine or penalties, it would not be considered as a temporary difference. Rather, it gives rise to the permanent differences. Example G, more or less have previously also been discussed, that personal expenditure which hasn't been incurred to earn any business income would not be allowed as a business expense. So any personal expense would not be allowed as a tax expense while computing the business income. This is the general principle that you may see all and over again in all the heads of income. Coming to example H, this is a specific disallowance of expense in case of association of persons oblique partnerships. For partnerships, there is specific restriction that if partnerships or AOPs claim expense on account of profit on debt paid to their members or commission paid or salaries paid to their members would not be allowed as an expense to such AOPs or partnerships. The concept behind is that the partners would be earning income otherwise by withdrawing their after tax profits from the AOPs, and such after tax profits should not be allowed with the additional tax savings on account of profit on debt brokerage commission paid to the members. So the legislature has also discouraged cash payment of expenses by disallowing that cash expense in excess of PKR 250,000. Uh, legislature want to encourage that all the expenses should be made through the cross banking channels. If it is less, if it is beyond the limit of PKR 250,000. So in short, in any expense paid in cash or other than cross banking channels in excess of PKR 250,000 would not be allowed as a tax expense. This is a general principle, and exception to this general principle is that you can pay cash expenses while making payment on account of utility bills, freight charges, travel fare, and other levies and taxes, etc. So example J is a specific example for pharmaceutical manufacturers. Uh, uh, there was a trend that different multinational pharmaceuticals were claiming expenses on account of sale promotions, advertisement, publicity, which in tax authorities' view is not in line with the rationale of the business, and that such expenses were claimed in excess of the rationale of the business. Though by considering this, the legislature has recently pronounced that any such expense in excess of 10% of the total revenue would not be allowed. So this is very particular to the pharmaceutical sector and not generally applicable. So coming to the next important example, which is L. In this specific tax adjustment, that legislature want to discourage the sales to persons which are not registered for the sales tax purposes. So idea is that an industrial undertaking or a manufacturer should make maximum sales to such persons who are registered under the Sales Tax Act, and for that purpose they have disallowed certain proportion of the expenses which are made to unregistered person, though they were liable to be registered, but remain unregistered for whatever reasons. So under clause L, certain proportion of such expenses would not be allowed to the business, particularly the manufacturer and industrial undertaking, if they continue to sell goods to such persons which are liable to be registered under the sales tax but not registered. So these were the important. Obviously, these not be considered an exhaustive list of all the tax adjustment, but this should be considered as an important, generally used tax adjustment while computing the business income of a corporate entity or individual or AOP running the businesses. So in case if anyone have any question about these specific tax adjustment, can come forward.
Hi Ali, can you hear my voice? Adil, can you please confirm if I'm audible? I just want to confirm because I'm sitting in the room right next to Ali, so uh, I'm not sure if everybody else can hear me.
Farhan, you are audible.
All right, all right. Thank you. So, Ali, I think the people do have question in relation to your presentation covered so far. So one of the question that I had just marked, and it relates to actually the expense limit that you just described, PKR 250,000. So what she wants to know, I think, yes, what actually Nadeem Anjum had this question. So Nadeem Anjum wants to know expenses threshold of 250,000 is one expenses payment or it's a yearly limit or monthly? Please elaborate.
Thank you, Farhan, for putting up the question. So this 250,000 is per head account. For example, if financial shows printing and stationery head of less than 250,000, obviously that is on annual basis, then this rule of cash payment would not attract. And for example, printing and stationery head shows expense of more than 250,000 in an annual based computations or accounts, then this cash rule that discourages cash payment would attract. Farhan, any other question?
So, yes, Mohammed Wasif Islam has asked question, how much expenses paid in cash form? I think this probably relates to the question that you just answered. Mohammed Wasif, it's requested if your question is different than the question Nadeem Anjum had asked, so kindly elaborate on that. And so there are other questions as well. I think, and the question that we have received so far mostly relate to the previous session, and I think it's I'm responding to those questions one by one or in writing, and there is one particular question that we can take at the end of this session. And also one, so somebody had requested for prayer break. uh, I think we are half an hour into our session. So if I think I could hear the azan. So if you Ali are comfortable with taking 10 minutes break now, or you want to take 10 minutes. Feroz, are you there? Uh, Feroz, if you
Farhan, can you hear me?
yes, Feroz, I can hear you.
Then Ali will explain this.
Listening, what are you trying to say?
Sorry, Feroz, can you hear me? Uh, so
Yes, Farhan.
somebody had requested for the prayer break, and we are like half an hour into our session. So is it okay that we take break now, or should we take break at 50
I think to
past six?
I think to match with other cities, we can delay for 10 to 15 minutes. Then we can have the prayer break, so that all the
All right.
cities are aligned for the prayer.
All right, all right.
Is that is
I think
that all right?
that's fine. That's fine. Ali, I think we can proceed with the session, and then we will take break at 10 to 7.
Thank you, Farhan. So I would take this opportunity to explain the clause of cash. Am I audible?
Yes, you are.
So Farhan told me that there are a couple of questions regarding the cash expenses and their relevant modalities. So the thing is, if one specific account head exceeds the limit of 250,000, then this cash rule would be triggered. And obviously, this general rule have certain exceptions. If single payment is less than PKR 25,000, then this cash rule would not be tracked. Similarly, in case of utility bills and freight charges, that can be made in cash to become an allowable expense. And the questions related to the part one of tax computation, we can answer those at the end of this session. So, moving towards another important topic of business income and computations thereon is the tax depreciation, and obviously it will give rise to the temporary differences due to the fact that in the financials, the depreciation, the accounting depreciation may be computed as per the company's policies adopted by the company while preparing the financial statements, whereas in the tax law, every asset has been prescribed with specified depreciation rate, which will be discussed in coming slides. Therefore, it would naturally attract the temporary differences between the expenses allowed under accounts and expenses allowed under tax accounts. So the basic definition of depreciable asset is we generally know to as have normal useful life for more than 1 year, likely to lose value by wear and tear and obsolescence. And I have produced an example that piece of land obviously will not lose its value, therefore it could not be considered as a depreciable asset, and it should be used to earn with a business income. So there's another important topic while discussing tax depreciation is that you guys may have seen that in accounts the lessee who have acquired fixed assets would be charging depreciation in the accounts, whereas as per the tax law, such depreciation on leased asset as a lessee would not be allowed. Rather, the lease rentals would be allowed as a tax expense. So while computing the taxable profits, we have to add back the accounting depreciations on owned asset as well as on the leased assets, and we would deduct the tax depreciation and the lease rentals paid on account of leased assets. Written down value WDV is a simple concept Tax WDV is similar to the accounting WDV, but the difference obviously would be that the cost as recorded in the tax accounts would be deducted by the accumulated tax depreciation, including initial allowances, to come at the tax WDVs. And when an fixed assets or depreciable assets is disposed of and the payment received on account of disposal is higher than the tax WDV, then such difference would be considered as a gain and would become taxable under the head business income, not under any other head, because the concept is this asset was previously used to earn the business income. Therefore, the gain on disposal of such tax gain on disposal of such asset should also be taxable under the head business income rather than under any other head. And similarly, if there is a loss on disposal of fixed assets or depreciable assets, the loss should be considered as the deductible expense or allowance while computing the business income. So, so here is the specified depreciation rates allowed by the tax law, which can be or cannot be different, which can be different from the policies adopted by the companies or other taxpayers while computing their accounting profits. For buildings, the depreciation rate is 10%. For furniture, fixtures, and similar items, the rate would be 15%. Plant and machinery would also attract the rate of 15%. Computer hardwares and associated and allied items would attract the rate of 30%. And for mineral oil concerns, the installations would attract the rate of depreciation at the rate of 20%. And 100% depreciation in the year of purchase of the asset would be allowed for the ramp builds. This is a very specific example. In case of hospitals and all that, a ramp build for disabled persons. So under the tax law, parallel to the tax depreciation, there is a concept of initial allowance to encourage installation of plant and machinery in our economy to generate more employment and more economic activity. So the taxpayers earning business income if install plant and machinery for the first time in a tax year in a Pakistan, they would be allowed, in addition to the depreciation, an initial allowance at the rate of 25% of plant and machinery, which would obviously will give rise to the temporary differences and covered in the deferred tax while computing the financial statements. Similar to the depreciation, tax law allows amortization of intangible assets, and primary condition to claim the amortization expense is that the underlying intangible asset should be used to earn the business income. For example, accounting software should be used to use in an activity or to prepare accounts of the business to claim any amortization expense. And obviously, if an amortizable asset or an intangible assets have useful life less than an year, then such the expense incurred thereof would be charged as a period cost, and there would not be any need of amortization. However, if an intangible asset have a useful life more than a year, then the concept of amortization would be triggered. So the definition of intangibles is pretty simple under the tax law, which covers many types of intangible assets, from softwares to licenses to IPs and any similar rights or expenditures that can give rise to a benefit to a taxpayer for more than a year. But it obviously they have specifically, the tax law have specifically excluded self-generated goodwill and other accounting treatment from the definition of intangible assets. The example of such accounting treatment can be an adjusting entries sometime can be initiated at the time of merger and acquisitions of companies, which is not to be considered as intangible asset under the tax law. uh, that would obviously can give to a temporary difference as well. And self-generated goodwill by the businesses would not also be allowed as an intangible asset, which on which amortization can be claimed. I can share an experience with the tax authorities while discussing this intangible assets. Sometimes the tax authorities pick any specific expense on the presumption that this specific exam is giving benefits to the taxpayer for more than a year. For example, in one of my client, they have agitated the fact that the expense incurred on account of advertisement is giving rise to benefit to the taxpayer for more than a year. Therefore, it should not be allowed as a period tax cost. Rather, it should be amortized over a period of so and so years. So we have successfully defended the company's case by explaining the fact to the authorities that this should not be considered as a long-lasting benefit of the company, because the company have to incur such kind of expense on year-to-year basis on every year. If such an expense was giving rise to a benefit of more than 1 year, then the company may not have to incur an expense in coming years. So that's now a settled principle that an expense to become intangible and amortizable should give rise to a benefit for more than a year, and a period cost expense should be allowed in a year in which it was incurred and should not be deferred or portioned over the over or spread it over different or many years. To compute the amortization, the law has given a very simple formula wherein the cost of the amortizable asset would be divided by the normal useful life of such intangible assets. And if the useful life of such intangible asset is not ascertainable with clarity or with certainty, which can be a case in different intangible assets, then the law allows that normal useful life of such assets can be considered 25 years. Previously, it was 10 years where life was not ascertainable, but recently the legislature has extended such limit from 10 to 25 years to spread the tax expense on account of amortization for on a longer period. For cost of intangible asset, there is a general principle which you would see in any cost of fixed assets, is that it should be incurred to earn the business income. And the concept of 25 years has already been explained to you guys. There's another concept under the amortization section, is that if an intangible asset is acquired during a year, then the amortization would be allowed on the remaining period of the tax years by prorating the such tax expense on the remaining period of the tax year. And law has prescribed a formula, but the underlying principle is that the remaining period would be used as to allow the amortization expense. So here is another capital nature of expense which sometime companies incurred before the commencement of the business, which is also not allowed as a period cost. Rather, it is allowable on the concept of amortization. Uh, for example, the companies would be incurring feasibility studies or construction of prototype in manufacturing concerns or trial production activities before commencing their business, and expenses incurred on such account would not be allowed in the year in which it was paid or incurred. Rather, it would be capitalized in tax accounts, and amortization would be available over the time of 5 years at the rate of 20%. So before moving towards other topics of the allowable tax expenses, if someone has any specific question or any comment or any suggestion, please come forward.
So Ali, I think one person has raised hand. Sabi Mohsin Salim. And Sabi Mohsin, I am going to unmute you and then you can ask your question. Sabi, I've unmuted you. I think Ali, Sabi probably has dropped out probably due to some technical issue. But we have a question. Uh, I think I'm gonna read this question. I'm going to read this question. It's a question from Burhanuddin, and it's a bit lengthy question, but I'm going to read it for your sake, and then you can respond to the question. So the question that Burhanuddin has asked is that if a sole proprietor raised funds from third person, that is family and friends, and make an agreement to share the sole proprietorship business net profit on the basis of funds invested by third party, so if the net profit is shared between sole proprietor and investors at the ratio 50 to 50, what amount of profit is considered as taxable for sole proprietor for business income, and how the profit share is treated in computing the taxable income of the sole proprietor?
Can you please
Uh, I'm going to repeat the question for clarity purposes. So, if a sole proprietor raised funds from third person, that is family and friends, and make an agreement to share the sole proprietorship business net profit on the basis of net funds invested by third party. If the net profit is shared between sole proprietor and investors, which I believe is the third party, at the ratio 50 to 50, what amount of profit is considered as taxable for sole proprietor for business income, and how the profit shared is treated in computing the taxable income of the sole proprietor? What head of income is applicable to shared profit received by third person?
Thank you, Farhan, for the question. So this is a very interesting question. Let me open my mic. So, the essence of such treatment is giving rise to the partnership. Although the funds generated by the individual from their family is a separate agreement, and on the face of it, the individual running the business is a separate person from the persons who are investing the money. But in substance and in essence, they are running the business as a partnership or as an association of persons. Tax authorities obviously can view this as a partnership concern. Uh, and under the partnership, there is no taxation on the members of such partners. Rather, the partnership is considered as a separate legal person for the purpose of taxation. And if such association or person or partnership have paid their taxes duly under the law, then the sharing of after-tax profits would not be chargeable to tax in the hands of members. So the essence of this transaction, which I understand, is though there's loan coming from family to a person, and person is running the business, but the essence and substance of the transaction is that they are running the business as an AOP. On the other hand, there is another creativity in such taxpayer or business can make if it attracts lower tax rates. Then they can do that. The person running the business can show loan payable to their members, to their family members in their balance sheet, and but in such case, they would not be allowed to share any profits of such business, because under the Pakistan laws, though this is a legal matter, but I can share my experience. Uh, the profit on that cannot be earned by private parties. So the loan given by the members, family members, to such individual may not give rise to profit on that under local laws of Pakistan. Only the banking companies and other NBFCs have the right to earn interest incomes. So if it is to be considered simply as a loan transaction, then the investors, the family members, may not be able to get the interest or get the return on their investments. Farhan, is there any question? Is there any additional question?
Uh, yes, Ali, there's one more question, which probably relate to pre-commencement expenditure, which I believe that you're still to cover.
I
So,
have covered. You
uh,
can repeat it.
uh, I can repeat the question and then you can respond accordingly. And then after this question, we can move towards the prayer break because we are almost 3 minutes to 7 p.m. So I think it's okay to give the prayer break now and then we can move on. So I'm going to repeat the question for your clarity. Manzoor Ilahi has asked question that if a company registered late, like the expense occur in July and the company registered in August. So does the expenses of August will be undeductible in the annual financial statement? Please elaborate on this.
Our local tax law hasn't provided any specific clarity on such a situation, but our general understanding is that even a taxpayer have been registered with the tax authorities after incurring of expenses, then such expense should be considered as a pre-commencement expenditure and should be allowed as a tax expense, obviously at a rate of 20%. Though such taxpayer have to prove to the tax authorities going forward that such expenses were originally incurred for such to establish the business, and not for any private use and all that. So the principle would be that such taxpayer have to prove to the tax authorities that such expenses have been incurred, although before getting itself registered with the tax authorities, but the same has been incurred for earning the business income taxable under the local law.
Thank you, Ali, for the clear answer. I think we can take pause for 10 minutes. It's 7 p.m. Here in Lahore. So we can pause for 10 minutes and we will rejoin at 10 past 7. Hello, everybody. Welcome back. I hope everybody's back. We can resume today's session. Ali, before we move forward, I've just marked one question that I think you can answer quickly. Uh, though it's probably not related to today's session, but I think it can be answered quickly. So Ijaz Mazhar has asked question: can we adjust refundable income tax against salary which arrives at the time of filing of tax return?
At the time of making payment of the So, Ijaz, this should be considered as frequently asked questions by the employees, even by myself to my employer, that if excess tax has been paid by me while filing my last return, whether the impact of such excess tax should be allowed as my benefit or as a credit while making payment of salaries by the employer to the employee and the withholding thereon. So technically, the question answer to this question is no, because tax law does not allow to account for the previous year refunds by to compute the withholding liability on part of employer while making payment of the salaries. Any other question, Fran? Or should I continue with the session?
So Ali, I would like to take liberty and would like to ask a follow-up question on this question. One thing is clear that the employer, when making the payment, would be required to withhold tax in accordance with the applicable law. I think another angle, what Ijaz might be trying to ask is whether the any refundable income tax, any refundable income tax from the previous year would be adjustable against the tax liability on the salary arising at the time of filing of filing of income tax return. We are clear that yes, the employer would be required to withhold income tax in accordance with the applicable law, but would the refunds available be adjustable against the tax liability on the salary income?
Thank you, Farhan, for clarifying this question. So, tax refunds arising from any kind of tax stream would be available to be adjusted against any tax liability while filing the tax return. And coming specific to this question, if an employee is filing its annual tax return, and for certain reasons, the tax paid during the year is less than the tax liability computed at the time of filing of return, then obviously such employee would be allowed to adjust the previous year refunds while filing its income tax return. This is different from the employers with responsibility of withholding tax while making payment of salaries and the employee making his final tax annual declaration to the tax authorities. So, in short, while making annual tax declarations, employees would have the liberty to adjust the previous year refunds, whereas the employer, while making deductions, is not allowed to account for such refunds. Though it seems to be kind of tricky and absurd, but this is how it is prescribed under the law.
Thank you, Ali, for clarifying this question. I think we can now resume with today's session. Please go ahead.
Thank you, Farhan. So before the prayers break, we have discussed the pre-commencement expenditure, and we should move on to other tax adjustments or tax deductions allowed by the tax law while computing the business income. So for R&D's scientific research and expenditure, the tax law allows such expense as period cost to come at the taxable profits. But the catch is that these expenses should be incurred in Pakistan, and then it would be allowed as a allowable tax expense while computing the taxable income. And scientific research has been specified, has been prescribed by the local law, which includes any expenses incurred in the field of applied or natural sciences, contribution to scientific research institution, but but it does not include any expense incurred on acquisition of fixed assets, including depreciable or intangible assets, land, immovable properties, and uh, and scientific research also does not include the expenses incurred on behalf of ascertaining the location or quality existence of natural deposits or natural resources, if any, available in the land of Pakistan. So tax also allow the specific tax expense on account of entities incurring specific training and employees training and facilities, wherein any if a business entity contribute to an institute which is situated in Pakistan on behalf of any training activities or endeavors of their employees, should be allowed as a tax expense. But the preliminary condition is that such institute is located, should be located in Pakistan. And any institute which is located outside Pakistan, and companies pay to such institutes which are not located in Pakistan, then such tax expense or expense would not be allowed under tax law. So coming to another topic of tax expense, which is interest cost, which is a normal phenomena while running a business in Pakistan. So the entities running business is generally allowed the interest cost as an expense while computing taxable profits. Uh, there is a concept under the IFRS that a certain interest cost can be capitalized if it is incurred on the loan used for the acquisition of fixed assets. So under the tax law, the same treatment can be extended for such plant and machinery which has been set up in Pakistan for the first time. And in such situations, such interest cost can be capitalized even under the tax accounts, and accordingly, the underlying expense would be available in a shape of tax depreciation rather than as an interest cost. So, but there's a catch that if there is a business which is already a going concern and there is an addition in plant and machinery, and to make such an addition in plant and machinery, the entities take loans from financial institutions and pay any interest cost thereon, then such interest cost should be allowed as a period cost rather than to capitalize the same. So this is a disputed kind of a disputed topic in Pakistan, that which capitalized cost under the accounts would be available as a tax depreciation or as a period cost for the year cost. But this can be seen as a case to case basis. Under the depreciation, I have briefly discussed the concept of initial allowance, which is detailed here as well, that on certain assets, the tax law allows initial allowance in addition to the tax depreciation at specific rate. And initial allowance is only available on the plant and machineries of the businesses and at the rate of 25%. So, bad debts are normal phenomena of any business, and no one can foresee there would be any bad debt for sure at the start of selling any goods or incurring any services or providing any services to an customer. So bad debt is a normal phenomena, but uh, we can learn in this slide that how tax law would treat bad debts under the tax laws. So in accounts normally prepared in Pakistan, the expense on account of bad debts are generally available at the time of making provisions against bad debts. But under the tax law, this is not the situation. Under tax law, the bad debts, the debts should be actually written off in the accounts to be claimed as a bad debt and to claim as a tax expense while computing the taxable profits. And the provision for bad debt or provision on receivables would not upfront allowed as a tax expense. To become it allowable, there are three conditions which has been prescribed under the law, that this bad debt should have been made part of the revenue. Obviously, if a customer is not willing to pay or delaying the payment, the relevant revenue should have been recorded in any previous accounts in financial or in tax accounts. So the condition A would generally be met. The second condition is that the account shows actual return of such bad debt, and it should not be any provision against the receivables. And third one is, which is most tricky and the most disputed and discussed in precedents and higher authorities, that the entity running the business have made reasonable efforts to recover such bad debt. Sometime court says that such reasonable efforts would be to file a suit against such clients, but in other cases the reasonable efforts may be considered as sufficient that an entity has made sufficient follow-ups from the customer. So this vary from the specific case to case and facts of the entities. In case bad debts previously allowed as an expense under the tax accounts become recouped or become paid by such clients, then tax law provide a specific treatment, which can easily be explained by way of an example. For example, in an account, there is a provision for doubtful debt of amount rupees 100, and there is actual bad debt of rupees 40, and subsequently such customer provides amount of 80, then the 20 rupees would be considered as an additional business income chargeable to tax, which would be computed as 100 minus 40, 60, and 80, and the difference between 80 and 60 would be considered as an additional income earning from the business. On the flip side, on the other side, if such amount received is lower than the difference of 140, which was 60, then such difference would be allowed as a tax expense. The underlying concept is that if expense is recouped or such bad debt is recovered from a certain threshold, then it should be considered as an additional income because previously it was allowed as an expense. On the other side, if the recovery of the bad debt was lower as compared to the provision for doubtful debt and additional provision was required, then it would naturally be allowed as a tax expense. At the start of our presentation, we discussing the specific tax adjustment. I have said that in Pakistan, accounts are generally prepared on by following the IFRS framework, and the tax law also recognize application of IFRS in their rules. And for companies, it has specifically been required that while filing the annual tax return, such companies should annex the audited accounts while filing their returns. So, by following that principle, it can easily be construed that for the company's business income would be computed on the basis of accrual base of accounting, and it would not be the cash accounting would not be used for the companies. But for the persons other than company, which are individuals and AOPs generally, can use either cash basis or accrual basis at their own discretion. And we all know as students of accounting that cash-based accounting, under the cash-based accounting, income would be when it is received and expenses would be when it is paid. And under the accrual base of accounting, income would be on the basis when it becomes due from the customer, not at the time of make receive or payment. Rather, it becomes income and it is due, and expenses can be recorded when it becomes payable. So generally, the tax accounts would follow the accrual base of accounting with specific adjustments which has already been discussed. Long-term contracts is applicable on specific sectors of the economy, such as the construction service providers, the builders and developers. So under the long-term contracts, uh, if a contract is completed more than after the tax year, for example, if a contract cannot be completed within a tax year, which is normally July to June, then the underlying taxation of such contract would be construed under Section 36, dealing with long-term contracts. The concept of computing such income is more and similar to the IS 11. You may have read that the income would be computed on the basis of percentage of completion method. And the total of costs which have been planned to be incurred under the cost would be apportioned among the period of such contracts. So this concept is very similar to IS 11, with the exception that tax law only recognize the cost method of percentage of completion method, rather revenue method. So this is in short very similar to the IS 11. So Farhan, is there any specific questions you can please highlight?
Yeah, yes, Ali, thank you. So there are two questions that I have highlighted in meanwhile. So one, the latest question from Mohammed Suleiman Simab. He is asking, kindly confirm whether initial allowance of 25% is in addition to the depreciation.
Yes, it is in addition to the normal tax depreciation. Obviously, the condition would be that such plant and machinery should be used first time in Pakistan. Then, in the first year of such usage, both two types of deductions would become allowable under the tax law. One is initial allowance and other is normal tax depreciation. To compute this, the initial allowance would firstly be deducted from the cost and the remaining tax WDV would be available to compute the normal tax depreciation. In short, both deductions would become would become allowable under the tax law. Initial allowance would be available only in the first year, as apparent from the name, and the tax depreciation would be available over the time of usage of such asset under the reducing balance method and at the rate specified under the schedule.
Thank you, Ali, for the clear answer. Another question is also being asked from Suleiman Sima, and I'm gonna just paraphrase the question because it was in pieces. So Suleiman is trying to ask what is the discourse available in case withholding tax in withholding tax is deducted in excess on the salary or the income from property. What is the discourse available in such case where withholding tax is deducted in excess of the prescribed limit?
Uh, for employer, they have 12 months to discharge their withholding obligation. For example, in a specific month, if an employer has deducted additional tax while making payment of salary, obviously this can be compensated in coming months. For rental income, for payments on account of rents, the same principle can be adopted because generally in Pakistan the rents are based on a monthly or quarterly basis. Uh, as far as overall withholding responsibility is met by the withholding agent, this can be used as a tool to overcome such a situation where excess tax has been withheld.
Thank you, Ali. Another question that Mohammed Wasif Islam is asking is that in long-term contract, revenue will be calculated on proportional basis.
It would be computed on percentage of completion method basis, which would be the overall cost estimated at the start of initiation of the contract and the planned cost incurred during a tax year.
Thank you, Ali. I think now we can resume with the session because for now we don't have any further questions, but we will take more questions as we proceed.
Thank you, Farhan. So before concluding our major topic of today, which is business income, there are other aspects which would be discussed in detail in coming sessions, which will be related to more related to the international aspect of the business income, where non-resident persons or foreign companies earning certain type of business income in Pakistan through independently or through a permanent establishment, and other important concepts which any student of tax should be aware of, because there is a specific session allotted to such topic. Therefore, it would be most suitable to discuss same in detail in such session. Technically, obviously, that become a business income topic. However, separate session has been named after international taxation. That then it would be more suitable to discuss the same under that session. So, coming to the last head of income prescribed under the local tax law, which is income from other sources, and the nature of incomes falling under such head is pretty much clear from its name that if any income is not specifically captured by any head of income, then the income can fall in income from other sources. And the important examples have been listed here under, which includes dividends, royalties, interest income, additional payment on delayed refund under any tax law. This I want to clear. When we lodge to get refund from the tax authorities, and every modalities have been fulfilled, and if there is any delay on part of the tax authorities to encash such dividend, then the tax encash such refunds, then the taxpayer is entitled to receive interest on such delay of encashment or refunds, and such additional receipt can be taxed as income from other sources. Other important examples falling under income from other sources are and include rent, subleasing of immovable property. The primary leasing of immovable property falls under the head of income from property, whereas subleasing would fall under the income from other sources. And if a building is given on the rent together with the plant and machinery, for example, a running factory, overall factory is given on a lease modalities or lease arrangement, then the landlord, the income earned by such landlord would be taxed under the head income from other sources. Other important examples are prize bonds, winnings, uh, prizes offered by companies, gifts earned or lottery earned under different schemes announced by different companies that can be taxed under the head income from other sources. So last two examples of income from other sources are very critical and important to understand. Uh, if a person receives a loan from another person, other than obviously the banking companies, if such loan is received in cash, then the tax authorities and the tax law would assume that this is an income from other sources earned by the borrower. To avoid such additional incidence of tax, it is highly recommended that the loan transactions should be made in cross banking channels. Otherwise, the tax law would assume it as an income from other sources in the hand of borrower. And similarly, if any cash is paid, as a gift to another person, other than through a cross banking channel and other than to a close relative, then it should be considered as an income from other sources in the hands of donee. And similarly, if a property is given to a person which is not a close family member of a donor, then such property, the fair market value of such property would be considered as an income from other sources taxable under the hand of donor. Close relatives would not include family, friends, or colleagues. There's specific definition given in the law, which includes the ancestors, descendants, spouse, dependent childs. Uh, so close relatives. Definition of close relative is should not be considered as a general one, but it is prescribed under the law. Income from other sources obviously would not be taxed on gross basis. Rather, expenses can be allowed to such income from other sources, but the main principle to allow such expense would be that such expense is specifically incurred to earn such income from other sources. And a specific example has been given under the law to allow zakat as an expense against interest income. So, before moving towards another topic, Farhan, can you share if there is any question?
Thank you, Ali. Yes, we do have a couple of questions, but the questions seem to relate to things that we probably have covered previously or in earlier in this session or in the previous session. So I think we can respond to those questions. I'm gonna repeat the first question that comes from Haris Saita, if I'm pronouncing that right. So Haris is basically asking, can employer adjust withholding tax on salary of employee against adjustable advance tax paid or withholding tax paid by the employee during current tax year? Uh, I think we have already responded to this question.
Not specifically. Uh, there are there are four adjustments which are allowed in the tax law for the employer to account for while making while completing its withholding obligations. Those four are tax credits on certain investments. If employee have made certain investment in shares or mutual funds, then the law allows tax credit on such investments, and an employer should consider such tax credit while completing its withholding obligation. And the other example is credits allowed on account of donations. Uh, uh, and third example is insurance. There are credit allowed on the insurance schemes. For example, employees is entitled to tax credit when they invest in certain insurance schemes. And the fourth one is obviously specified investments, which includes public shares, listed shares, and all that.
Thank you, Ali, for the clarity. Another question that Junaid Nasir has asked is, if an AOP generates income from export proceeds, then how much income that an individual partner can take as taxed AOP income? 50% each partner share in AOP?
As I previously clarified that under the tax law, AOPs should be considered as a separate legal person from its partners. Any tax liability of AOP would be limited to such AOP, and after tax profits of AOP would be which would be dispersed among members would not create any additional tax charge. So if an AOP is earning income from exports and discharging its tax liability on final tax regime basis by paying tax at the time of exporting, the goods, then there would not be any, there should not be any additional tax liability on the part of members. Just one thing I want to clarify is that partners can add their share from profit in their tax returns only for the rate purposes, and exclude such income as a credit. In principle, the partners should not be taxed again on their incomes as a part of their as part of the share from AOPs.
Thank you, Ali. I think there was enough clarity on the question. There's no further question related to the parts that we have covered so far in the today's session. So I think we can move towards the last part of today's session, and then we can take some more questions from the previous session that we have highlighted. Thank you.
Thank you, Farhan. So last part of our session is losses, and there are specific rules to adjust business losses or other losses while computing the taxable income chargeable to tax. So for the year, loss arising under any head of income can be adjusted against the income of any other head other than salary. So salary income would be taxed without adjustment of losses, and any other income would be available to absorb the losses arising from any other head of income. And as a hierarchy, the law has prescribed that the losses incurred on behalf of any head would be consumed by the income from business as a last uh, at last in hierarchy. So, under the carry forward of losses, there is a general principle that only income from business and income from capital gains, the losses incurred under such heads could only be carried forwarded. For example, if there is a loss under the head of property in a property head, then the underlying loss would not be carried forward to adjust in future incomes. Only the loss incurred under the head of income from businesses and capital gains can be carried forward to be adjusted against future incomes. Depreciation and amortization losses can also be carried forward. Business loss is simply defined here, which is business loss other than depreciation and amortization losses. The law, due to the fact that the law prescribes different treatment for business loss and depreciation loss, therefore these two has been specified separately. Capital loss obviously would be the loss incurred on at the time of disposal of any capital asset. So business loss can be carried forward up to 6 years after the end of the tax year to which it relates. So this can easily be remembered that any loss which is beyond the period of 6 years would be wasted, or there should not be any deferred tax asset on a loss which is older than the 6 years. But if there is any loss which is within a period of 6 years, the accounts in the accounts you may see a deferred tax on account of business as the business losses. Obviously, while preparing accounts, we have to make sure that while recording the deferred tax asset, the recoverability of such losses should be ascertained. and the loss incurred on behalf of under the head business income would only be available to be set off against the business incomes. It cannot be set off against any other head of income, and it will be carried forward. So for depreciation and amortization, the losses can be carried forward for infinite unless it is completely set off against the business incomes. Depreciation losses to be carried forward and to be adjusted against the business income of the future can be utilized against 100% of the business income if the overall business income is less than PKR 1 million. If such business income is in excess of 1 million in future years, then such depreciation loss would be available to be adjusted only up to the level of 50% of the business income. Similar to the business losses, the capital losses can also be carried forward to be from the end of the tax year to which it relates. And for AOPs, there is a specific rule that if a loss sustained by an AOP, such loss cannot be utilized by its member against its own income other than the share of AOPs. So the principle which is already discussed is repeating itself, that the AOP should be considered as a separate legal person from its members, and any loss incurred by the AOP should not be available against the incomes of the individuals.
Uh, I think, Ali, your voice is probably either breaking down or there's too much echo. I can see a lot of people uh, confirming that over the comments. So we are trying to sort out the technical issue because it was probably fine. But if there is any question regarding the parts that we have covered and weren't clear, uh, we can you can ask questions on that part as well. And Ali probably has concluded the today's session as well. So what I'm going to do now, I'm going to first take the question related to today's session and the people that have asked the questions pertaining to today's session, and then we will take a couple of questions related to the previous session. So Ali, the first question that I'm going to repeat is that Mohammed Wasif Islam has asked if we have paid tax on AOP income when it distribute to individual, then again tax paid on individual income or not. I think I'm going to paraphrase that question for clarity.
I guess this question has. I guess this question is already been addressed. Nevertheless, I will reiterate the previous discussion that the AOP should be considered as a separate legal person from its members, and the share from AOP after tax profit share from AOP in the hands of individuals should only be considered as inclusion in the income for determination of rate of tax. and if such rate of tax has been determined, then it should be excluded by way of taking certain credit. So principally, the underlying principle is that if AOP has given tax or shown tax in its on its income as a AOP, then its members should not be taxed twice again on such income.
So I think your voice is probably still echoing. What I can do is that you can directly respond to questions from my system for sake of clarity. Uh, the next question that I'm gonna ask is from Sheroz Habib. So Sheroz Habib is interested in knowing if total withholding tax is deducted more than the actual liability, how to make refund from FBR. You can respond directly.
Sure, thank you. So this is more of a practical nature of the question is more of the practical nature. Though the law has prescribed the modalities and the specific uh, measure to claim refunds from the tax authorities, but in Pakistan, the tax authorities are generally reluctant to give such refunds, especially in a case where the refund amount is not substantial for the tax authorities. For us, 100,000 or 1 million may be substantial, but in overall schemes of tax authorities, they may not be considered as a substantial amount to get it refunded. So this is more of a practical issue. That the fund should be allowed under the tax law, but in practice, small refunds are generally not allowed by the tax authorities.
Uh, Thank you, Ali. Just for everyone's clarity, Ali is speaking from my system. So if there are going to be two voices from my profile, so just for everyone's convenience and reference. Last question for today, Ali. So this question was asked in the last session as well. So this question basically pertains to income from property as well as the allowance or the perquisite of accommodation that's actually provided by the employer. So the question is already in front of you, and I think, can respond. This question was from Mohammed Suleiman Simab. So instead of repeating this long question, you can respond back.
Suleiman Simab has put up a question mainly relates to two parts that salaries given to a federal government employees, and accommodation given to such employees, and the withholding responsibility of federal government while making payment of rents on behalf of such employees. So, Suleiman, there is a two topic or there's a two aspect of this question, and both are independent to each other. So if an employee earns any house rent allowance from an employer, it should be treated as a taxable part of the salary. And if free accommodation is given by an employer to the employee, then there is a rule that 45% of the basic salary should be considered as a taxable perquisite. And if any deduction on account of salary has been made against such perquisite, then this perquisite should be netted off against such perquisite. In your question, in your example, you have mentioned that 5% of basic salary has been deducted on account of free accommodation given by the federal government. So it's not completely free because the employee is born has been born the 5% of basic salary of getting such free of cost accommodation. So in short, the 45% of basic salary less by or deducted by 5% of basic salary, and the net amount should be included in the taxable salary. And the other aspect of your question was, what about the withholding made by the federal government while making payment of rent to third party in which such federal employee would be residing? So this is another responsibility and prescribed in the tax law which the federal government would be fulfilling in addition to accounting for that, the government as providing a free of cost or a less cost value of free Thank you, Farhan, for putting up interesting questions for me. Is there any other question or any attendee want to speak or something? I will be pleased to address such a question.
Thank you. I think I had lost my connection in between the last question. So I think we are good for today. I would like to apologize for the last half an hour because there were a lot of, I think, distortion in the voice. If anything is not clear from the last part of this today's session, you can ask the question, and we will try to respond in the next session as much as possible. So thank you very much for bearing with us for today's session, and inshallah we will meet next on Friday with the next part of this 8 session series on the Pakistan tax. So thank you very much and have a good night.
Thank you, everyone. Thank you. Bye bye.